gonna work, okay? So, chapter 10 is about the, have a lot of concepts. Calculation-wise, it's easy. Alright, so I'm gonna, set up the stage. Okay, so we are in the control. So we are still in the control, Ryan. So we are talking about, at the end of the day, we are gonna figure out who is doing, good job or bad job, alright? So now, when we get to the control, so there are two different levels. So when you evaluate the operational level manager, so that's called operational control. And then that control actually is, we already discussed that in chapter 9. So that's chapter 9, material variance analysis. Now, chapter 10, we're gonna evaluate the performance for the middle level manager or the top manager. So that will be the management control. So management control is what we try to focus on, okay? Is that okay? So, so I think that's it, okay, kind of circle that. All right, so now let's, if I circle it will work. What do I have? All right, so, so since we're gonna talk about the manager, so then we are gonna get into operational structure. So centralized, decentralized. Centralized means one person make decision. When one person make decision, we do not have to evaluate because that person will be responsible for his or her own action. So that's why we do not have control issue. Only when we have multiple people in the organization make decision, that's a decentralized, then we will have a control issue. All right, so then we're gonna focus on decentralized. All right, so now, so this is a decentralized management control issue. Now, first thing you wanna figure out is why firm, in what scenario firm will decentralize? So there are different scenarios. So for instance, if you have a strong individual customer service needed, right? So if you want to have somebody to talk to the customer, make a decision immediately, then you wanna decentralize. For example, if you have a lot of location, right? So like a McDonald's, right? So they have many locations. You want the location manager have decision rights, so then you decentralize. So if you have a lot of competition, you wanna decentralize, all right? And then if you wanna promote innovation, you wanna decentralize because the people on the floor, people in the location, at the location, they will have more information, right? So then they will know where to improve and how to make it better. So that's why, those are the scenario you wanna decentralize. So this is basically the goal, so I want you to read through those slides carefully. So those will be the good reason why you wanna decentralize. Now, why we don't want to, what's the drawback? So drawback is, first of all, the manager may not have the same interest or incentive as the central manager, right? So there's a misalign. All right, so in the sense that, the manager want empire building, in a sense, they want to manage, a bigger team, right? So they want to manage 10 people, it's better than manage only 5 people team, right? So that's an empire building incentive. Where the company probably will say, well, so if 5 people can get the job done, why do we have to have 10 people, right? So then that will be a misalign. So same thing goes with when the manager have empire building incentive, they want to manage. So when it gets to the choose the project, right? So between 1 million project versus $100,000 project, right? So empire building manager probably say, I want to go with $1 million project. Even the $1 million project have a lower rate of return. So that will be the empire building incentive. You do not want to, you want to be careful because the manager, when we get to the middle level or top level, you want to worry about the people's incentive because their decision, you can only observe their decision or the consequence of their decision. But the decision, is it driven by different incentive or it's driven by different information? You do not know, right? So it's really difficult to figure out, distinguish those two. So that's why you have to be, aware. There is a possibility when the manager chooses a $1 million project, it's not because they get bad information, it's because the manager want to manage a bigger project. Okay, so that's empire building. And then also duplication, so that will be another drawback, right? So you make a decision about how many people to hire at the central level, but also at the local level. So that will be a repeat, right? So repetitive. All right, so those are the so simple thing. Now, so this is basically get to chapter 10. We are doing control issue in decentralized organization for management control. Now, basically, we are gonna go to the 3 issues, 1, 2, 3, okay? So you're gonna follow those 3. So today we're gonna talk about responsibility accounting. Next week, we're gonna talk about management compensation and transfer price. So that's the 3 topics we're gonna talk about in chapter 10, okay? All right, so responsibility accounting. So responsibility accounting, this is just another accounting we added, okay? So a structure we added to the organization. So here's the definition. So so it's basically, we try to figure out, how to, organize information together with the organization structure, decentralized organization structure in the firm. Now here's the definition for responsibility accounting. It's a system of accounting that recognizes responsibility center. You need to know this definition, okay? And then throughout the organization, action of those center by assigning particular revenue and cost. So it's basically what do those centers do, all right? And then we are gonna match the measure based on what they do, so that the measure will speak to what they have done. Then we can use the measure to evaluate their performance. So that there's a match between the measure basically is a revenue, cost, and all the other things, so basically accounting number with the performance of those responsibility center. All right, so that sounds like a variance analysis. Actually, it's pretty much similar to variance analysis. I'm gonna show you that. Now, this is important. Responsibility accounting actually emphasizes the notion of accountability. So I want to introduce you something which is related to so a little bit structure, a little bit history about accounting, but give you some ideas about where this accountability notion is about. All right, so here is the quote from Professor Yuji Juri. It was a professor, he passed away a few years ago from Carnegie Mellon University. So this is his work, Theory of Accounting Measurement in 1975. So I'm gonna read the quote. All right, so once a manager uses another person's money to make investment in a business, that sounds like all the company in the public traded company, right? So you purchase the company's stock, you give the money to the company, and then the company's manager will use your money to generate more money, right? So invest in the business and then, so generate more money. So that's okay, so this is basically, most of the public traded company. Of course, if you have a, family business, so it's all the, your family member, try to manage this business. So that's a little bit different, right? So that's, entrepreneur kind of business, that's a little bit different from public traded company. So this is what we are talking about, public traded company. He has contractual obligation to account for how the money was spent and how it was earned. So you should be able to make it very clear where you spend the money, and then how the money, how the money is spent, and whether the money is spent efficiently and effectively. So that's basically what is meant. So accountability is what distinguishes accounting from other information source. So there will be all different kind of accounting system in the company, but then accounting system is the only system of which we emphasize accountability. Accountability in the sense that we have to write every single number down. If we have transaction, we're gonna record that. So that's important. So accountability, so you should take some pride in terms of, learning accounting is so hard, right? So it's boring, but it's also hard. But then you should take a pride in, learning this, because that will give you sense about, this is in all the business school, accounting is the only discipline with stress of the accountability. All right, so now this leads well into this book. So this is The Reckoning, which is by Jacob So. So he's a historian at USC, University of Southern California. So the name of the book is called Reckoning, Financial Accountability and the Rise and Fall of the Nation. Okay, so it's the title of the book is already nice. All right, so this is the first page of the book. Okay, so I just took a picture and then it's in your slide. So this is a very interesting anecdote in the sense that, okay, so back in 1661, all right, so the Sun King, Louis XIV, all right, so he had the habit of, okay, because the country was booming and it was really rich and it had a lot of states out there, so he carried a book, a count book, all right, so in his pocket, basically recording all the numbers, all the, what land he had, what other, income he had and all that. And then so the book was, prepared by his accountant. His accountant's name is Cobell. So Cobell, but this is practice. This is almost like the good accounting practice has been recognized and then respected in the society, back in 1661, by the king. And of course this practice died quickly within 20 years. 1683 Cobell died and nobody can do the job and they become a mess. And then of course the king randomly spend money without knowing what he had. So they basically bankrupt the nation. And then of course when you have bad number, you do not want to carry that in your pocket, right? So that's why they stop all the practice. So this is basically the anecdote about this. So the good interesting thing about this book is, because accounting usually is boring, right? So we do not see a lot of TV drama about so basically center on accountant, right? So there's only one movie. Have you watched the movie, right?
Yeah.
So there's only one movie about accountant, and then all the others are about like cops, doctor, lawyer, right? So we do not see any good TV show about accountant. But this book actually, and same thing in the art, right? So if you see paintings, right? So you do not see a lot of paintings regarding accounting. But Jacob So actually found several paintings around that time, basically shows how the importance of the high social status of accountants at that time. So I'm gonna share this with you. At least you get a little bit flavor of this. So this is the painting. So this is Luca Pacioli. Everybody know who he is? So this is the father of double entry accounting, right? He's an Italian mathematician. So in this painting, he was teaching algebra to his student, right? So his student, you can stand right next to your master. You have to stand behind. So that's why he is more to the front. He's doing the algebra, and then so this book is he was compiling all the. So he's not he claimed himself as not a really good creator. So he's not inventing all the theorem and the math, but he's really good at explaining things. So that's why he compiled all the algebra stuff, the geometry stuff at that time. There is one chapter on double entry in that book. All right, so this is basically so this is something he claimed, right? So the road to transcendentness was through the clarity of mathematics and how data were recorded in books. So he think so the most knowledgeable people in the society at that time should know accounting, and not everybody can know or can learn accounting. So that already put accounting in a very high social status. And then he also claimed accountants needed more skill and discipline than lawyer. So we do need the discipline. That's the accountability. All right. So discipline of accounting was central to accountability. That's basically So all the things he found because he's all right. So this is another painting, 1514. 1514. So this is showing a merchant. All right. So so people struggle between the devotion to the religion, but at the same time making a lot of money being rich, right? So then this is basically portrait being rich because they all well dressed, and then in a good background and furniture and everything. Behind here is basically accounting tools, right? So you do not, okay, it's not random people can learn, can know how to do accounting, and then counting money, and then also there's, okay, some, okay, religious book or maybe Bible, right here. Now, okay, so this is, okay, so this is again, okay, portray how accountant actually associate with the well-being of the nation, and then in the, okay, so if you do a good accounting, you can be rich. So that's why accountant usually, okay, will be dressed in like really nice clothes and doing the book and have all the records, okay, at the back, all right? So when we get to 1540, all right, so that's when the nation got like basically bankrupt. And then so then the artists start turning and start, okay, joining. So before you will see, well, so the accountants, okay, all stir and then but still good looking and all, and then all like serious, right? So look like well respected. But okay, so when we get to, okay, 1540, and you notice they look a little bit, okay, suspicious, right? So it looked like doing something tricky. So this is, okay, when the nation is not doing well, was not doing well, so then of course you start making up numbers, and then the discipline part, the accountability part got lost. So that's where the accounting or accountability is associated with the rise and fall of the nation. All right, so very interesting book. If you interested, and he wrote several interesting book, and there's another book is about the history of the free market, so which is also a really great read. So you can, okay, check him out. All right, so that's a quick, okay, so something sidetrack. Okay, so now let's get back to, okay, responsibility accounting. All right, so those are the steps, right? If you look at the steps, first step is the only thing we added. Okay, in responsibility accounting, you identify the responsibility center first. Once you do that, the rest of the 2, 3, 4, 5, if you look at that, that's variance analysis, right? So we get the target, which is the standards. Then we get the actual performance, we get the variance, then we decide what kind of corrective action we will take. Very clear, right? So this is basically responsibility accounting. We're gonna look at the responsibility center. For each center, we're gonna find a measure, and then once we decide what kind of measure we're gonna use, then we're gonna do, okay, variance analysis. All right, now, okay, responsibility center. There are 4 types, okay, 4 types of responsibility center: cost, revenue, profit, and investment. Different responsibility center will use different measure. All right, so you should be able to, okay, know the definition, know, like give a 1 or 2 example, right? So cost center, only responsible for cost. Example, producing department, right? Don't care about revenue, only care about the cost. Support department, only care about the cost, right? So then, okay, we are gonna look at the static budget, flexible budget, actual, and then get a variance. Okay, so look, only have cost. There's no revenue. Only partially, okay, on the income statement. Now, things about the cost center, you kind of have to know, because we are dealing with manager, right? So you kind of have to know what potential strategy, okay, incentive they have. Now, okay, so I give you, okay, 3 different, okay, things, okay, to think about. So the first thing is, so sometimes because if you do the measure differently, you probably will drive the manager to do things differently. Sometimes, okay, the decision they make may not be aligned with the company's, okay, interest as a whole. All right, so for instance, okay, cost shifting. So cost shifting is basically, okay, so if you focus on the variable cost, you say, okay, variable cost is the main responsibility for the cost center manager. Now, one thing the cost center manager can do is to shift the cost from the variable cost to fixed cost. How can they do that? By replacing not so old equipment. All right, so because the variable cost can relate with the equipment that can relate to maintenance, right? So repair, okay, you use the supply to repair, you have indirect material, indirect labor. Now, if you have an old machine, of course you will keep repairing, and then you're gonna generate a lot of variable expense or variable cost. Now, if you replace the machine with a newer machine, then of course you do not have to repair or do the maintenance so frequently. So that basically but then the cost of replacing the old machine is a fixed cost. Then you essentially swap the fixed with the, so you get to the scenario where the manager will say, if you want to evaluate me with variable cost, and by the way, here is my request to purchase a new machine, right? So then that's basically essential, and then the manager can make a good argument. So essentially, you're gonna drive the manager to request more capital investment, and which as a whole for the company will not be a really good thing. All right, so the second possibility is, well, so if you only focus on this year or next year, that's basically the short term. So the manager can say, well, so do I have to repair machine? Do I have to do maintenance? They can actually skip 1 or 2 maintenance, right? So in the short run, so the cost will come down, but in the long run, you can get more breakdown on the machine. So that's also bad, right? So those are the scenario where the manager can do something differently just because you set up the measure so specific. All right, so then there's also something called the budget sled. So this is basically, in the budget, usually the central manager, if they try to set the budget for the divisional manager, then they will need the input, right? So the divisional manager can say, well, so we have so many difficulties or obstacles for the coming year, right? So we have to take time to train the employee. We have to, so the inflation is so high, and then so they're gonna lay out a lot of different scenario. So to the point that the central manager said, okay, so here is your cost, right? So as long as your cost is not exceed $100,000, you are good, right? So then, but if the actual cost is only so maybe 80,000, right? So then you kind of create a budget slack for the manager, so the manager will be able to easily achieve the goal without doing much effort. All right, so that's basically some issues you have to understand. All right, so revenue center. So this is just basically revenue, right? So I'm only looking at the sales budget versus the actual revenue to determine whether the revenue center manager is doing a good job or not. Examples of revenue center will be marketing, and then some sportswear department, right? So those will be the example for revenue center. Now, let me see. Okay, so profit center. So profit center is basically adding both the revenue and cost together. All right, so not only the manager will be responsible for revenue, but also responsible for cost, right? So not only you have to worry about the sales, you also have to worry about the cost. The reason is, so sometimes it's just cheaper to do that, right? So you do not want to produce in Houston and make a sale in Seattle, right? So you probably want to do, well, so if Seattle have a bigger market, you probably want to move the production closer to Seattle, right? So that will be the profit center. All right, now investment center. So investment center, not only the manager has to be responsible for profit, basically revenue and cost, they also have to be responsible for investment. So which means they can borrow from the local bank, right? So then to invest and purchase asset. All right, so then in that sense, so if from the profit, if revenue and the expense, that will be owner's equity. But if you have to borrow money and you invest, then that will relate to asset and liability. So that's why you have to evaluate the overall, not only the balance sheet, but also the income statement. Okay. All right, so in terms of evaluating the divisional manager's performance, all right, so usually, those are the 3 commonly used measures. All right, how many of you know return on investment already? Some, right? Return on, at least you heard, right? How many of you know residual income? Some, less, right? Have you heard about economic value added? A little bit, all right? with ROI. You know how to do this. What's the problem with ROI? Alright, so this is what we are gonna do, alright? I'm gonna explain those three. The problem with ROI is it induces under-investment problem. Okay, if you use return on investment to evaluate divisional manager's performance, you have to be aware the manager is gonna under-invest. Under-invest means there are some good projects they are gonna give up. Okay, they are not gonna invest. Alright, which is actually bad for the company as a whole, because you don't want to as long as you have enough resources, you do not want to give up on any good project, right? So usually in the finance term, it's NPV positive, right? So this is not okay. So this is under-investment. The under-investment problem induced by ROI can be fixed with residual income. All right. Now, residual income is a less popular term because it's a purely accounting term. Nobody cares too much about accounting. All right. So that's why the idea residual income can fix the under-investment problem is very appealing. So that's why some smart managerial accounting professor and also practitioner, they package the residual income and then sell that into as economic value added. All right. So sell that to the company. So now it's very popular for the company to use EVA. All right. So economic value added. This is actually a trademark. Okay. So term. So use EVA to the company. So that's basically the relation of those three. Is that clear? So I'm gonna show you this. Okay, how this works. All right. Now, so let's look at evaluation. So we're gonna look at three different questions, right? So is the performance measure consistent, right? So with the authority. So if this is an investment center, if you only evaluate based on profit, that's not consistent. Agree, right? So because there's an investment portion of that. If this is a revenue center, you cannot use the cost to evaluate because the revenue center will not be responsible for cost. All right, so that's important. Does the performance measure reflect the result? So that's important as long as you match, right? So you match the performance measure with the action. That should be able to reflect the result. And what action might manager be taking? So that basically relate to the strategy, the possible strategic consideration you have to think about when it comes to manager. Because if the manager have decision, right? So they will have all different kind of incentive. They can be self-interested. They can be for some other reasons, and then all this will be not observable to the central manager. So those are the concerns. I'm gonna use the example to talk about 5 measures. So divisional income and financial ratio, those are easy. So all the other 3, I'm gonna just go through how we calculate this. All right. So this is the question. So basically, this is what we got the information collect for Western and Eastern. So remember, this is December 31st. We already get the actual number, right? So those are not estimation. So we have revenue, COGS, interest expense, operating income, after interest expense, net income. All these numbers are collected from the income statement. Then we have operating assets, beginning, ending. All right. So operating asset is different from financial asset. All right. So make sure you understand that distinction. So operating assets are all the assets used for operation. Inventory, cash, accounts receivable, PPE, right? So those will be the operating assets. But if you have investment, that's financial assets. Okay. All right. So now given this, so this is what we will do. So we will compare, using divisional income. So that's easy. I'm not gonna talk about this. You just look at the income statement, right? To see which one is better. We can also use GMP and asset turnover. So GMP is about profitability, right? So it's a gross margin divided by sales. Asset turnover is about efficiency, how efficient you manage assets. So those you also know how to do the calculation. So I'm not gonna go over this in detail. Now the drawback of using those financial ratios is you cannot combine them, right? So it's very, very difficult. It's almost like a different ratio talk about different aspects of the company. It's really difficult to put them together. Give you, okay, so how do I say a company with low GMP but high asset turnover versus another, okay, division have a high GMP but low asset turnover, right? So how do I compare those two divisions? So it's very difficult to do that, okay? So that's the drawback, okay, just be aware, okay, so be aware. So the financial ratio, when you have, okay, 10 different financial ratio, which I know in financial accounting, intro to financial accounting, you probably practice a lot, right? So looking at the financial statement and calculate the financial ratio. But how to use the financial ratio, that's okay, that's another important thing you have to pay attention, not just do the calculation. A lot of people, okay, who do not know accounting, if you give them the formula, they can do the financial, okay, calculation, but they may not be able to explain, right? So being able to explain, that's important. All right, so now I'm gonna focus on, okay, 3 and 4, all right? So this is, okay, I'm gonna just, okay, go through. So this is 1, this is 2, all right? You have the slides, okay, that shouldn't be a problem. All right, so then I mentioned, okay, the problem using the financial ratio, you cannot combine. All right, so now let's look at ROI. So the formula of ROI is operating income divided by average operating asset. All right, so if you look online, okay, Google the term, there will be different kind of, okay, definition for how to calculate ROI. I wanna be consistent. For this class, we are gonna do operating income as earnings before interest and income tax. Okay, so not every formula is doing this, but it doesn't matter. We are gonna focus on income purely just coming out, okay, generated from production. We're not gonna consider interest, we're not gonna consider tax, right? So it's just, okay, revenue minus COGS minus operating expense. That's your operating income. Divided by average operating asset. We're not gonna use only the ending, so sometimes the formula will just use the ending. We're not gonna use that. We use consistently just this one formula. Are we okay? So, but okay, it doesn't mean the other formula are incorrect. In some scenario, okay, it's just for simplicity, right? So because you have less hassle to, okay, collect information. But for us, okay, so I wanna be consistent. We are gonna use this as a formula. All right. So the average operating asset is beginning plus ending divided by 2. Don't forget that. Okay. If you only use the ending, that means you are wrong. Okay. You have to use the average. Okay. All right. So so this is how we're gonna calculate. Okay. So for operating income, okay. So let me explain. So this is the information we have. We have operating income after interest expense. We have interest expense because this is already subtract the interest expense. So that's why you have to add back, all right? So you're gonna add 468 plus 480. So that will give you the operating income. Are we okay? So 948 is a 468 plus 480. So that's how you get the 948, okay? And then for average operating asset, you do the same thing. You're gonna look at the balance sheet. So 3,000, 3,500, you add them up, divided by 2, that's your average, okay? All right, so that's where those numbers are coming from, okay? So, and then you use the operating income divided by the average, so then you get ROI, okay? ROI for Western, ROI for Eastern, okay? So now ROI for Western, Eastern, okay, you look at that, okay, the higher the better, you can compare, all right? Which one is doing better? Eastern is doing better, slightly higher, okay? So that's basically how it's very straightforward to compare. Now, how many of you heard the DuPont decomposition? DuPont decomposition. DuPont decomposition is one way to kind of, okay, so those are the things, well, so in practice, right? You see the need, okay, so I see my ROI, but I want to know how well I'm making money, how well I'm managing my asset. How can I do that? Then you separate, okay? So this is basically, well, if you do, so if you do, ROI as operating income and the average operating asset, alright? Are we okay? So it's, I'm putting in two, alright? So then I'm gonna put the sales, down here and sales up there, alright? So I didn't change the formula, correct? But then I have a new interpretation because the first one is about profit. How much, if I make a dollar sale, how much profit can I generate? The higher, the better, right? So if you make a dollar sale, you can, okay, 20 cents is your profit. That's better than 18 cents is your profit. Now, for this, okay, ratio is sales over average operating asset. So that is, okay, how well you manage your asset. $1 of investment in asset, how much sales I can generate. The higher, the better, okay? So that is a DuPont decomposition. So if you look at right here, so this is basically, well, so you have the operating income over sale times sales over average operating asset, you get margin times, okay, turnover, right? So that's the DuPont decomposition. All right, so for DuPont decomposition, so of course you can kind of, okay, so use this, so if I go back to the example, right? So for margin, I'm gonna use, okay, 948, I already have the sales number, all right? So the sales number is 5,200 for Western, okay? So if I'm using 948 divided by 5,200, I get this number, all right? So that's operating income divided by sales. I get this number. All right, so now if I'm doing the same for Eastern. So now if you look at the profitability, Eastern is doing better, right? So $1 of sale, Eastern can generate about 20 cents as profit, and Western is generating about 18 cents as profit. Now, I'm using 5,200 divided by 3,250, that I'm getting the asset turnover. So that's 1.6 for Western, 1.47 for Eastern. Now, what this means is, and Western is doing better in terms of managing asset. So it's a $1 investment in asset, Western can generate 1.6, $1.60 in sales, while Eastern can generate $1.47 in sales. So that's the interpretation. You have to be able to interpret, okay? So then those two, you multiply them together, you get exactly the same ROI. So that's the decomposition. Okay. All right. So so this is, okay, basically what's going on. And then of course you can play around with a lot of, okay, DuPont decomposition. So for instance, if I'm putting, so this is a margin, all right? And this is a turnover, okay? So I can have a curve. So in this curve, ROI is exactly the same, all right? So doesn't matter, okay, which company on this, okay? So ROI is exactly the same. So this company have lower margin, higher turnover. This company has, so A has lower margin and higher turnover. B has higher margin and lower asset turnover. Okay, so think about B. B can be company with lots of capital investment but higher margin. What kind of company can that be? Lots of capital investment, higher profit margin. I give you two choices, grocery store and utility company. Which one do you think is B? Utility company or grocery store?
Utility.
Utility, right? Large investment, lower asset turnover, okay? And a higher margin, okay? So this can be utility. And then the other, okay, probably is grocery store, okay? So they have low margin, right? So when you sell the eggs and the milk, you do not get a lot of, okay, profit, right? But then, okay, you also have, okay, higher turnover. Now, And so this is the reason, okay, so now, okay, what's the use of this? So when you start thinking about how to improve the company's ROI, this is okay for A. For B, okay, the way to go is increase your asset turnover, right? The asset management. For A, that will increase your profitability, right? So this is why in the grocery store, you're gonna see a lot of mix of, okay, not only you sell grocery, but you also sell like a fresh flour, the pharmacy. Those are the high profit margin business, right? So you add to that, that will increase the profit margin for the grocery store. All right, so that is okay how you can use decomposition. All right, so so the next thing, okay, so this is okay. So the good thing about ROI, all right. So I'm gonna go through. Okay, so encourage the manager to focus on everything, right? So sales expense, that's the operating income, and the investment, that's the average operating asset. Now it encourage okay cost efficiency because the bottom is average operating asset, right? So you do not want to increase the investment. If you increase the investment, your ROI will go down. So that's why okay it will discourage excessive investment. All right. Now, okay, and then because it's a ratio, it's very easy to compare. Now, the problem with ROI is it induces underinvestment problem, okay? The reason is because, all right, so if we go back to the calculation, all right? So for Western, okay, so the ROI is already 29%. So any project below 29% will be discarded by the division. The reason is because if you invest anything below 29, the overall divisional ROI will go down. Okay, so that's why. Okay, so this is basically from the company as a whole. That's an underinvestment problem. All right. Now, I want to introduce return residual income. All right. So let's see how residual income will fix the problem. So residual income. So this is the definition. We have OI, the operating income, minus the minimum rate of return. So now instead of using the divisional rate of return, we are gonna use the constant company level minimum rate of return. So this will be the return everybody will use in terms of investment. That's how you correct the underinvestment problem. Multiply by the average operating asset. Now clearly this is a number. This is a dollar amount. This is not a percentage, right? So okay, so so the operating income is the actual performance, and then the minimum rate of return time average operating asset, that's the expectation. Now if you get okay a positive number, so that means your actual performance exceeds your expectation. So that's a good surprise. Now, if it's a negative, that means it's a it's a bad surprise. If it equals 0, it's possible residual income is 0. 0 means there's no surprise. Okay, so that's the interpretation. Now let's see okay how we can do this. So you use the same. Okay, so we already got this number. Okay, from ROI, we have operating income, average operating asset. Minimum rate is 15%. So what you have is 948 minus 3250 times 50%, 15%, you get this number. All right. So do the same thing for Eastern. Okay, 558 minus 1900 times 15%, you get this number. Well, okay. So that's how you calculate residual income. Now, one thing you have to make sure you are not compare those two numbers because this cannot be compared. All right. So this is almost like an apple to orange comparison. You cannot compare. Okay. Western give us a higher number of residual income, so that's why it's doing better. That's not a correct conclusion. The reason is because there's so the size effect there. Okay, so you cannot do that. Okay, it's almost like you compare $1 million revenue or profit from Apple versus $1 million revenue from a small company, right? So that's not the same thing. Okay, so this is exactly the same idea. All right. Now, so let's see. So how we can use. So you can read this, okay, so the strength, of course, correct the under-investment problem. The shortcoming, of course, is okay, it's an absolute value you cannot compare. Alright, so now let's see how we can use this to fix the under-investment problem. I'm gonna use an example to show this, alright? So the first, okay, so this is operating income, beginning, ending, alright? So, and then we consider a project, okay, with 16%. Alright, so the first thing you will do is calculating the ROI, alright? So ROI for this company, for this division. Alright, so the ROI, alright, so is operating income, that's 25. Everybody get that, right? So the average asset, so the average operating asset, so that's 10K plus 15K and divided by 2. So that's 12,500. We okay? So then divided by 12,500, so we get 20%. Alright? So for this division, anything below 20%, you're gonna drag down the ROI. Anything above 20% is good, it's gonna increase ROI. So let's see, okay, whether that's indeed the case. Alright? So the project ROI is 16%. Okay, by the rule, you already know the manager is not gonna invest because 16% is below 20%. But let's see, okay, how the ROI will change. Alright, so then I'm gonna calculate a new ROI, right? So then that will be 2,500, which is the original, plus, alright, so I'm gonna add the 8,000 and times 16%, right? So this is the new operating income. Everybody agree? So that's the 1,280, right? So 1,280 is the new added, right? So you invest in the project, you're gonna add additional return. All right, so and divided by the average operating asset, which will be the original plus 8,000. All right, so if you do the calculation, all right, so that's 18.4. All right, so that is showing under investment problem. We okay? So once you invest, your return on investment is 18%. Without investment, 20%. No investment, right? So as a divisional manager, you're not gonna invest. So that's under investment problem. Now, how are we gonna fix this with residual income? Now, with residual income, we do the same thing. All right, so this is what we will do. All right, so I'm gonna erase this. All right, so I'm gonna, show the residual income. So residual income, I'm gonna use 2,500 minus 15%, because that's the minimum rate of return. So now, 16% is higher than 15%. From the company perspective, you wanna invest, right? So the whole idea is, well, so you do not want the divisional manager to use its own divisional ROI as the benchmark to invest. So that's the whole idea. So residual income will achieve that goal. All right, so and then 15% times 12,500. So I think it's 675. All right, so that's the residual income before the investment. After the investment, all right, so and then you do the same thing. All right, so you have 25. I think this is 1,280 and minus 15, and so this is 25 plus 8,000. All right, so then that will be so I think it's a 705. All right, so that is okay. So from the same division, you can compare the residual income. Without the investment, your residual income is 625, sorry, 625, and with you get a 705. So this is why you want to invest. Okay. So the idea is very simple. I'm not gonna use your division is 20%, 18%, doesn't matter. But I want you to make a decision based on the firm level, rate of return, which is 15%. How can you do that? If you use the ROI every single division is gonna use its own ROI to make the investment decision. Only if you use the residual income, then you're gonna drag it down and make sure all the division is gonna use 15% as the benchmark, as the criteria to make the investment decision. All right, so that's how you fix the under investment problem. All right, EVA. So now I want to show you, okay, EVA. So you will see how similar EVA is, all right, to residual income. So EVA, look at the formula, all right. So it's after tax operating, it's operating income minus some rate multiplied by capital, right? So it's operating income minus a rate multiplied by an asset. That's exactly residual income. But of course we have to do some upgrade so that we can sell to the company. All right, so there are several upgrades. So first upgrade, we are gonna sell this to, this is for the benefit of investor and the long-term capital provider, basically the debtor, the creditor. And then whoever provide the money to the company. All right, so that's why we have to because they are the one claim the asset after the company paid the tax. So that's why we are gonna use after tax operating income. So that's the first change. Another change is we are gonna use the WACC, which is the weighted average cost of capital. So that's a very, very shining term, right? So we're gonna calculate the weighted average cost of capital, how much it costs the company to borrow money, multiplied by the total money we borrowed. So this will give you the total cost of using the capital, all right? So now we're gonna compare whatever return we get after tax with the cost of the money we borrowed. All right, so then so if this is a positive, that means we create wealth for the people who lend money to us. If this is a negative, we destroy wealth. So that's how you package the whole thing. All right, so this is positive, create wealth, negative, destroy wealth. All right, so now let's see how we can do this. All right, so this is a simple question. We have three different resources. We have mortgage bond, unsecured bond, and we have the common stock. So then we have we need a bunch of interest rate and everything. Now this is the after tax operating income. All right, so this is what you can do. All right, so first calculate WACC. All right, how do we calculate this? You list all the number together. 2 million, 4 million, 9 million. That's given by the problem. Okay, so I'm using 2 million, 4 million, and 9 million. All right. So then so total add up to 15. That's the total capital we invested. All right. So that add up to 15. Then we get a percentage: 2 over 15, 4 over 15, 9 over 15. All right. Now the after-tax cost, because we are talking about to the debt holder, the equity holder, so it has to be after tax. So only the bonds, we pay interest before tax. So that's why you have to take out the tax effect. So that's why you use the interest multiplied by 1 minus the tax rate. Okay? So that's a 4% times 1 minus tax rate and all this. But for the common stock, so the common stock is always it's risky to invest in stock, right? So usually the common stock will provide a risk premium. So it's basically, if I borrow money, if I invest money in the T-bill, right, so the treasury bill, that's risk-free, right? So if instead of investing that, I invest in the stock, then I should get a higher return because it's more risky. So that difference is called a risk premium. So this is why the cost of investing in the stock will be the risk premium, that's the treasury stock, so interest rate plus the risk premium 8%, 4 plus 8, so that's 12. All right, so given this, all right, so now we can calculate WACC. So the WACC is, I'm gonna do this right here. All right, so it's weighted average. So 2 over 15, 2.8%, 4 over 15, 4.2%, and 9 over 15, and 1.69 something, alright? So that is okay how you get WACC. So once you get WACC, then you can calculate EVA. So your EVA will just be, okay, so the after tax 1196. So I need that number, this number, 1196,500, alright? And minus 8.69% times 15 million, alright? So that is, okay, your WACC, your EVA, okay? Economic value added. Alright, so then if you do the calculation, that will be negative 107, alright? So this is negative, that means the company is destroying the wealth for the, okay, for the people who provide the, okay, the money for the, invest the money in the firm. Okay, so that is, okay, how you calculate EVA. I think I'm gonna stop here, so everything is not working. But I'm gonna leave the discussion, okay, for next week.